Netflix shares skyrocketed more than 14% after the bell Tuesday as the company posted better than expected results on the top and bottom lines. The streamer also reported an addition of 2.41 million net global subscribers, more than doubling the ads the company had projected a quarter ago. Hi guys, welcome back to Glory Investing Show. And in today's video, I'm going to give you a stock price analysis of Netflix. We'll also discuss whether it's a good idea to invest in this stock or not, so make sure to watch this video until the end. The current trends. First, let's talk a bit about the current trends in the stock market. The stock market has been correcting during the past few weeks, and a significant portion of the inaccuracy lies outside of the alleged bubble. Should everyone sell everything and leave the market now that the markets are declining? Currently, there is a decrease in the present value of assets as a result of the interest rate that is being used to discount future cash flows rising. I'm aware that it's complicated, so allow me to give you an example. Let's say in this example, we are valuing the stock in a business that will operate for 10 years, and then at the end of year 10, we will be able to sell that stock for 5 times its year-time cash flow. In year 1, each year of stock produces $10 in cash flow. Let's say the business can grow the annual cash flow per share by $2 each year for 10 years, resulting in a cash flow of $28 per share at the end of year 10. To calculate the value of the stock, we have to discount these cash flows back to the present day using a given interest rate. Let me tell you what the reason we do this is, that the dollar received 10 years from now is not worth as much to an investor as a dollar received in cash today. If I said I was going to give you $1,000 in cash today or $1,000 in cash 10 years from now, which one would you pick? Of course, you would pick the $1,000 today. This concept is also referred to as the time value of money. Earnings of Netflix. Now let's move towards the actual thing that this video is about. That is the good news from Netflix. Netflix just reported 14% increased earnings after bell, and they crushed it. They're up for some time now. This is important for Netflix shareholders. It's important if you're short because you're getting crushed, but it's also important for the bulls in the greater market. The index right now is up over 1% after hours, after a very volatile session, and their message is appealing to shareholders. They want to focus on revenue and profit, not subscriber ads. Subscriber additions were decreasing, so when you look at this company, it went through a period of accelerated growth and got to a point where it started to plateau. You saw a subscription dip. You saw fewer subscribers coming in, that growth starting to stall, and so the market looks at and says, is this a growth stock? Is it a value stock? Where do we value? How do we value this company? It's a lot like Meta, where they're pivoting and you have to try to figure out if this is going to work out long term or if this is going to continue to have deceleration. The good news. The earnings report shows the good side of Netflix shows they're starting to have some progress seeing subscription growth come back, and they're focused on other things, such as adding new tiers. There are going to be new tiers added that are essentially going to allow you to get Netflix with ads, and that's going to give you some options when it comes to a subscriber base. It's also going to give more revenue and the ability to forecast a little differently for Netflix. First, to focus more on revenue and profitability, Netflix will no longer forecast client additions every 3 months. Second, the company made the point in the shareholder letter that it generates operating profits of more than $5 billion, while other streaming services are in the red. Well, it is uncertain whether investors will pay attention even if Netflix urges them to shift their attention. Message for investors. Netflix has a message for investors. Stop stressing over subscriber growth and start concentrating on revenue and profit. In its quarterly shareholder letter, Netflix presented its position with several incisive remarks. The biggest streamer in the world announced that it will stop predicting paid subscription ads. The purpose of the change, according to the company, is to shift investor attention away from client development and over into revenue. Quote, "We are increasingly focused on revenue as our primary top-line metric," end quote, Netflix wrote as it reported third-quarter earnings Tuesday. Quote, "This will become particularly important heading into 2023 as we develop new revenue streams like advertising and paid sharing, where membership is just one component of our revenue growth," end quote. In addition to continuing to publish subscriber additions every quarter, Netflix will continue to provide estimates for revenue, operating income, operating margin, and net income, conventional measurements of profitability. It just won't be able to predict the future. It is important to note that part of the change is motivated by the increasingly wide array of revenue per user. A given subscriber could be paying $6.99 per month for Netflix's new advertising tier, which debuts in the US on November 3rd, or $19.99 per month for Netflix's premium no-ad service. What did Spencer Wang say? Quote, "Focusing on subscribers in our early days was helpful, but now that we have such a wide range of price points and different partnerships all over the world, the economic impact of any given subscriber can be quite different," end quote. Spencer Wang, Netflix's vice president of finance, said during the company's earnings call Tuesday. Quote, "That's particularly true if you're trying to compare our business with our streaming services." End quote. Netflix's advertising tier and the coming crackdown on password sharing should reinvigorate subscriber growth, but Netflix, which gained 2.4 million subscribers in the third quarter on an especially strong content slate, led by Stranger Things 4, may see quarters with 10 million or more subscriber adds as a relic of the past. Let me tell you that the company is aiming to shift investor attention away from parallels to a previous era driven by rapid expansion and onto the reality that its streaming business is profitable. This issue was specifically covered by Netflix in the competition portion of its shareholder letter. Here, it is important to note that Netflix stated, quote, "It's hard to build a large and profitable streaming business. Our best estimate is that all of these competitors are losing money on streaming. With aggregate annual direct operating losses this year alone, that could be well more than $10 billion, compared with our plus $5 to $6 billion of annual operating profit," end quote. Comparing Netflix and its competitors. Disney, Warner Bros., Discovery, Comcast's NBC Universal, Paramount Global, and other companies claim to desire to develop a strong streaming business, while Netflix claims to have already done it. Netflix admitted that some of its rivals might succeed through mergers and price increases, contrary to subscriber ads, where Disney has the upper hand. Because Disney Plus was introduced in 2019, which is earlier in its growth cycle, Netflix has a clear competitive edge. Last quarter, Disney added 14.4 million new Disney Plus subscribers, while Netflix lost 970,000. Additionally, Netflix will begin to crack down on password sharing next year, opting to allow people to have been borrowing accounts to create their own. The company will also allow people sharing their accounts to create sub-accounts to pay for friends or family to use theirs. You might also want to note that the majority of Netflix's net subscriber growth during the quarter came from the Asia-Pacific region, which accounted for 1.43 million subscribers. The US-Canada region had the smallest growth of Netflix's regions, contributing just 100,000 net subscribers. Remarks of the company's chief financial officer. Spencer Neumann, Netflix's chief financial officer, said during the company's earnings call, quote, "We're still not growing as fast as we'd like. We are building momentum, and we are pleased with our progress, but we know we still have a lot more work to do," end quote. That's all for today's video. I hope you enjoyed it. If you found this video helpful, make sure you smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below, and while you're here, click to watch one of these other 2 videos appearing on your screen right now. I'll see you there. Take care, and stay tuned.